It was a very pleasing result, a record result. At the pre-tax level, we made a profit of $69.5 million. Now, that is a reflection of the change in value of the portfolio, the size of the portfolio, which is up a little over 100% in the 12-month period as we had options exercised and we raised money through placement, etc. That was the first ASX book build, was the placement that we raised the money through. And also the performance of the portfolio in that 6-month period, which was up 14.2%. And over that period, we held as little under 70% of the money in the portfolio was invested in the market. We still had a reasonably high cash level. One of the most important things on the result was the dividend. The dividend was up from 6 cents in the interim a year ago to 6.5 cents. That's fully franked. And historically, what we'd paid in a half, we paid in a full year. Last year we paid a 6 cent interim, a 6 cent full year. That's 12 cents. So logically, you'd think a 6.5 cent interim meant a 6.5 cent full year, so a 13 cent dividend. Now, obviously, that depends on whether we have profits and whether we have franking. Now, profit reserve would allow us to pay at least double that 13 cent dividend, and our franking, at the moment we have sufficient franking for this 6.5 cents, and depending on franking we get in the next period, obviously will depend on how franked the next dividend would be. Now, in terms of, you mentioned about our cash level, how our cash levels increased. Why has that increased? After the election, we actually thought, like a lot of people, that the economy would pick up, and with a new stable government, and we really haven't seen that pick up that we anticipated. And when it became clear to us that wasn't coming through, and that's from how do we work that out? It was really from seeing the companies. Now, we try to visit as many companies as we can to get a real understanding of how the Australian economy is performing. We'd see 800 odd companies. We think it's 1,000 plus company visits a year. There's 5 analysts here doing that. So we really get really good feedback. And probably around October, late October, we realised that the economy wasn't picking up as we'd anticipated. So we started trimming some of our positions or making sure we had companies that wouldn't be affected if the economy didn't pick up. And what we've been seeing, unfortunately, more recently, is that we're going into a little bit of a downgrade cycle. And obviously, why has that occurred? It's because the economy hasn't picked up. The deleveraging appears to have been continuing, that the households have been doing, and even though there's very low interest rates. And normally with low interest rates, you would expect the consumer to be picking up a little bit. The low interest rates obviously have been very positive for housing, and we've got exposures, whether it's Sunland, we've got some CSR, various brickworks, various housing-related plays that have done as well. But really staying away from, to any great extent, is retailers, but more particularly retailers. We have a little bit of retail exposure, David Jones, but that's really on the Christmas. It's really a short-term position on the Christmas performance. But it's really being very nervous about the other retailers that are impacted by the lower Australian dollar. So the two negatives we're seeing is the economy, the consumer is still being fairly conservative, and also the lower Australian dollar is a negative for exporters and also for retail businesses.